Welcome. This breakdown has been put together by the experts at Pro Tax Accountant to help you understand a really crucial area of UK estate planning. We're going to be talking about a battle between two very different taxes. With your home, well, it could be caught right in the middle. Okay, let's dive into this.
It's an idea that makes perfect sense on the face of it. You've got a valuable property, you obviously want to pass it on to your kids, and you'd much rather they inherit its value instead of giving a huge chunk to the tax man. So you think, I'll just sign the house over to them now. It seems like the easiest way to sidestep a big tax bill down the line.
But hang on a minute. This is the hook. That one simple act could actually trigger a totally different tax, an income tax charge that you have to pay year after year for the rest of your life just for living in the house you thought you'd given away. How on earth is that possible? Stay with me. The next point might surprise you.
To really get this, we need a clear roadmap. So first up, we'll look at the big one, inheritance tax. Then we'll cover the common strategy people use to try and tackle it and the trap HMRC laid to catch people out. After that, we'll pull back the curtain on HMRC's secret weapon, the pre-owned assets tax, or POAT. And finally, we'll break down the massive choice you have to make and how to build your winning strategy.
Right, let's start with the first player on the board, inheritance tax, or IHT as it's known. This is the tax that gets everyone thinking about estate planning in the first place.
So, in simple terms, when you pass away, HMRC basically tots up everything you own, your house, your savings, your investments, even things like valuable jewelry or art. They add it all up, and that total value is called your estate.
And here's the number that makes people sit up. The standard IHT rate is a whopping 40%. Now, it's not charged on your entire estate, thankfully. Everyone gets a tax-free allowance called the nil rate band, which for the 2025/26 tax year is £325,000. It's the value above that amount that gets hit with that 40% charge.
And this is where it gets interesting, because you can actually build on that basic allowance. Thanks to other allowances, like the residence nil rate band, which adds an extra £175,000 if you leave your main home to your kids, a single person can pass on up to £500,000 tax-free. And because married couples or civil partners can transfer any unused allowances to each other, together they can potentially pass on up to £1 million without paying a penny of IHT. So, with a 40% tax rate looming over you, it's hardly surprising that people look for ways to shrink their estate's value while they're still alive. The most common strategy? Making lifetime gifts. Let's see how that's meant to work. Okay, the main strategy is all about making lifetime gifts. If you give away an asset and then you live for another 7 years, that asset is generally considered outside of your estate for IHT. It's what's known as a potentially exempt transfer. If you pass away within those 7 years, some IHT might still be due. But if you make it past that 7-year finish line, the gift is home free. Sounds pretty straightforward, right? But here is the massive catch. What if you gift your main asset, your home, but you don't actually move out? You give away the ownership on paper, but you carry on enjoying the benefit of living there. That's not all. Here's where most people go wrong.
Well, HMRC has a very specific rule for this called the Gift with Reservation of Benefit Rule, or GWR for short. It's basically designed to stop you from having your cake and eating it too. If you give something away but you reserve a benefit for yourself, like living in the house rent-free, then as far as the taxman is concerned, it's as if you never gave it away at all.
Let's make this real. Meet Ed, a business owner in London. To try and cut his future IHT bill, he transfers his house to his daughter, but he keeps living there, doesn't pay a penny in rent, and thinks he's started that 7-year clock ticking, but he hasn't. Because he's still benefiting, HMRC sees it as a gift with reservation. So when Ed eventually passes away, even if it's 10 or 15 years later, the full value of that house gets pulled straight back into his estate and gets hit with that 40% IHT. Now, of course, clever tax planners tried to find ways around the GWR trap. They came up with all sorts of complex schemes. For a little while, some of them worked. But HMRC got tired of playing cat and mouse and launched a very powerful counterattack.
And this is it, the pre-owned assets tax, or POAT. This is the crucial twist. POAT is not an inheritance tax. Let me say that again. It is an income tax. It's a yearly bill you have to pay on the benefit you get from an asset you used to own, specifically in those situations where the gift with reservation rules don't quite apply. It was designed to catch all those clever little schemes that tried to slip through the IHT net.
Now here's a little pro tip for you. POAT does come with a small exemption. If the benefit you're receiving is valued at less than £5,000 in a tax year, the charge doesn't apply. This is called the de minimis rule. That benefit is usually worked out based on the market rent of the property. So if the notional rent for the home you're living in is below £5,000 a year, you're in the clear.
So if you've gifted your home and you're still living in it, you're now staring down one of two paths. Either the gift is a gift with reservation and it's caught in the IHT net, or it cleverly avoids those rules but gets smacked by POAT, landing you an annual income tax bill. This puts you at a really critical crossroads.
This is the absolute heart of the strategy. Would you rather pay a smaller amount of tax, but every single year for the rest of your life? Or would you prefer to avoid that yearly bill and let your estate deal with a potentially much larger one-off IHT charge after you're gone? Getting this choice right is absolutely crucial.
Okay, let's put them head to head. POAT is an income tax paid by you, the person who made the gift, every single year. The amount depends on the property's rental value and your own income tax rate. IHT, on the other hand, is an inheritance tax. It's paid by your estate after you die, it's charged at a flat 40%, and it's based on the market value of the property at that future date.
And here's the really important bit. You don't just have to accept the POAT charge. You get to choose. You could formally elect to have the asset treated under the IHT rules instead, which switches off that annual POAT charge. But the decision is a huge one. For instance, if you're young and in good health, paying POAT for decades could end up costing far more than the IHT would. But if your life expectancy is shorter, paying a few years of income tax could be a much better deal than your kids facing a 40% tax bill on a very valuable property. It all comes down to your personal circumstances.
So with these two powerful taxes clashing, how do you navigate this battlefield and actually come out on top? How do you win this fight for your assets?
Let's just quickly recap the absolute must-knows. First, gifting your home while you still live in it is not a simple tax-saving trick. You will almost certainly trigger either the IHT gift with reservation rules or the annual POAT income tax. Remember, POAT is on you every year, while IHT is on your estate just once. And most importantly, you have a choice. You can elect out of POAT and back into the IHT world, but the right path depends completely on your age, health, income, and the value of your estate. And this really brings us to the most important point of all. This incredibly complex area isn't about finding clever loopholes anymore. HMRC has closed them all. It's about building a solid, informed strategy. The only winning move is getting expert advice that's tailored specifically to you.
To develop that winning strategy, you really need to speak with people who deal with this stuff day in, day out. You can contact the experts at Pro Tax Accountant to analyze your situation, help you understand the options, and make the right choice for your family's future. All their details are right there on the screen for you.
And finally, just a quick disclaimer. The information we've gone through today is for general guidance. Tax law is incredibly complex, and it always depends on your individual circumstances. So before you make any decisions about your property or your estate, it is absolutely essential that you consult a qualified professional, like the tax experts at Pro Tax Accountant. Thanks for joining us.